Welcome back. 100 points lower on the index now at the lowest point of the day. 25,380 is where the Nifty currently stands. So continuing this market conversation forward with Sahil Kapoor, who is the market strategist at DSP Mutual Fund, joining in. Sahil, good morning. Thank you for joining in. A lot of the current market over the last couple of years has been propped up by this retail fund flow that has come in from the domestic investors, but foreign fund flows have continued to remain elusive at best, if you could call it that, despite being net sellers all through and through this market correction from September until, say, March or April. Even today, they have not seen a meaningful pickup. What would you attribute that to, and when do you see a reversal happening, if you do see one, that is?
Sure. Good morning. So one thing is clear that foreign investors likely have more choices across the world with better valuations, and possibly they are picking that. And second thing is, a lot of foreign flows which come to India are through the passive route. So for example, if $100 flow towards the passive basket, India has 20-24% share, and they get those, India gets that flow. And over the last few years, emerging market as a whole haven't got a lot of flows. Third thing is that when you look at the emerging market basket as a whole, in the last 15 years, it has underperformed global equities by a very wide margin. It is only post-COVID that we've seen a large recovery in some of the emerging markets. And because of this underperformance of the last 10-15 years, I think the passive flows have also sort of reduced towards this basket. So mix of these reasons has made sure that India gets less flows of that basket coming into the Indian markets. Conversely, India has seen a very divergent performance. So our earnings trajectory has been much more stronger versus the rest of the emerging market. But still, I think we haven't really seen the flows that people would have expected or investors would have envisaged. When will these flows come? I have no clue. I don't have a crystal ball to see. I think we've already delivered over the last 5 years on best equity growth across emerging markets, whether it is in terms of returns or earnings growth CAGR, 20 and 24% respectively. Very stable currency, 4% annualized volatility, higher real returns in terms of debt securities, and still we haven't got the flows that we could have. So this combination is the combination of India doing well on all fronts, plus the global money also flowing towards emerging market. I think that is the important combination. As of now, it hasn't really worked.
But at some point, foreign investors are going to feel they're missing out, because as you rightly said, that despite foreign investors not investing in India because of strong domestic demand, etc., markets have done well. The last 20 years, CAGR, for instance, would be close to about 10-11%. So at some point that FOMO will come in, and it's not that valuations have also corrected. So will that factor, play a part in, foreign investors coming back into the Indian markets? How long, can they stay out of a growing market? And what would be your call on Indian markets per se over the next, say, medium term, 2 to 3 years?
I would say that FOMO-led flows may not be the most appropriate thing to, get for India. And think about this: if you go back to, let's say, the 2007 era or the 2002 to 7 cycle, by the time we hit the global financial crisis, nobody in their wild dreams would have thought that United States will come out to be the best performing market in the next 15, 20 years. And that is what has happened. Since then, about 18 years have passed, and S&P 500 or probably NASDAQ has beaten every other index in the world by a very wide margin. Very few stock indices come close to capturing the returns that they did. Nobody would have thought that it will happen from what the US financial markets went through. So my guess is that the performance of the past may not be the most appropriate way to judge whether these flows will come back or not. My sense is that a large performance uptick, which has happened even in US, has made sure that a lot of money still goes to the American markets. And I think once that outperformance goes out, I don't know why, but the numbers speak for themselves. For example, S&P 500 trades at 25, 26 times. And just about 6-7 years ago, let's say in the Trump 1 era, with very similar earnings growth rate, it was trading at about 18 times, right? So it has also re-rated. So maybe it doesn't do as well as it has done in the next 18 years, that will probably give some amount of a fillip to rest of the markets in terms of probably flows, and that could be a clincher. Plus, India will have to continue to deliver the earnings growth that it has, and that itself has become a very large challenge. So my guess is that flows will improve possibly because they are more cyclical in nature, and we are sitting at numbers which we haven't seen in 10, 20 years in terms of FDI flows of less than $1 billion in FY25. I think you have to go back to 2003 to see that kind of a data. And FI equity flows have also been very, very tepid. So cyclically, I think they might improve, but you need a number of factors or confluence of factors to see these flows come back.
Okay, while we're talking about factors needed to see the flows come back, right now we're seeing that markets are seeing a further knock from the highs. The Nifty is down around 100 points. We have the mid-caps which are down 166 points. And it is the banking index which is seeing a further cut. So watch out for the markets. We are seeing it coming below the 25,350 mark as well. It's very close to that, not exactly there. But watch out for the next important level as well. So Sahil, when we're talking about our own markets, valuations have been a talking point for the longest time. Now margins are at its peak. So what, according to you, could be the driver of earnings from here on? Do you think that is something that the markets could continue to be cautious about?
So my sense is that we are already sitting at margins which are quite high. When you look at the full universe of the first 500 stocks and look at the profit margins and EBITDA margins, we are close to at lifetime high levels. And the idea is that can margins go up from where they are right now? It's going to be very, very hard. I don't think except United States technology sector, there is any other index or sector in the world collectively operating at margins that we are right now. So it's going to be very hard for margins to go up. So what's left for our PAT or profit growth to go up? What is the key driver? It's the top line growth or sales growth. And sales growth, as you see, which was in high double digit and even exceeding 20% back in FY23 and 24, for the last few quarters has dipped down to single digits. In fact, in FY25, Nifty did a 1% PAT growth and mid and small cap did a 9% PAT growth. And the reason is very, very similar. Even with very high margins, if you don't get top line growth, PAT growth will just match the top line number. So if you get a single digit top line growth of, let's say, 9-10%, PAT growth is going to be 10%, 9%. And if your ROEs are 15-16%, which is what it is for NSE 500 stocks, paying a multiple of 25 to 27 times is going to be challenging. And therefore, it makes sense for you to tone down your return expectations. With what we've seen, double-digit 20-25% return post-COVID, I think those are stellar numbers. But the profit growth of 10% and ROEs of 15-60% do not justify for us to pay a multiple of 25 to 27 times. Therefore, it's very important to look for sectors which are cheaper in terms of valuation, doesn't have froth, and second, be conservative about your return expectations.
All right, Sahil, thank you so much. Insightful conversation there. Thank you for sparing time and joining us today ahead of the all-important earnings season that we are on the cusp of. We take a short break here, but the index now 100 points lower as we speak. More on the markets on the other side. Stay tuned.